Question 1. An investment advisor representative, IAR, is performing due diligence on a new hedge fund for a client. Under the Investment Advisors Act of 1940, which of the following is considered an investment advisor, IA? A. An individual who solely provides advice on U.S. government securities. B. A person who advises others about securities for compensation as part of their regular business. C. A bank that provides financial planning services to its retail customers without charging a separate fee. D. A newspaper publisher that provides general market commentary in its widely distributed publication. Answer: B. A person who advises others about securities for compensation as part of their regular business. An investment advisor, IA, is generally defined by the ABC test, providing advice about securities, doing so as a regular part of their business, and receiving compensation for it. Option B perfectly aligns with this definition, encompassing all three elements that trigger IA status and requiring registration, unless an exemption or exclusion applies. For example, a financial planner charging a fee for creating a portfolio recommendation for a client would be an IA. Remember the ABC test: advice, business, compensation, to quickly identify an investment advisor. Question 2. A client has a significant amount of their portfolio invested in a single blue-chip stock. The IAR recommends diversifying the portfolio by adding bonds and international equities. This recommendation primarily aims to mitigate which type of risk? A. Inflationary risk. B. Business risk. C. Market risk. D. Systematic risk. Answer: B. Business risk. Diversifying a portfolio by adding different asset classes like bonds and international equities to a concentration in a single stock primarily aims to mitigate business risk, also known as unsystematic risk. Business risk refers to the risk associated with a specific company or industry, which can be significantly reduced by holding a variety of investments not directly correlated. For instance, if the blue-chip company faces unexpected operational issues, a diversified portfolio ensures the client's entire wealth isn't solely exposed to that one company's struggles. Always remember that diversification is key to reducing risk specific to individual companies or industries. Question 3. Which of the following statements regarding the Uniform Securities Act is true? A. It requires federal registration for all investment advisors. B. It is federal legislation that directly regulates securities offerings. C. It serves as a model for state securities laws, known as blue sky laws. D. It applies only to broker-dealers and their agents, not investment advisors. Answer: C. It serves as a model for state securities laws, known as blue sky laws. The Uniform Securities Act, USA, is not federal law but a template or model legislation that states can adopt to create their own securities laws, commonly referred to as blue sky laws. These state laws govern the registration of securities, broker-dealers, agents, investment advisors, and investment advisor representatives within their respective states. For example, a state might adopt sections of the USA to regulate how broker-dealers operate within its borders. Think of the USA as a blueprint that states use to build their own regulatory framework for the securities industry. Question 4. An investment advisor representative, IAR, must renew their registration annually. If an IAR terminates employment with an investment advisor, IA, firm, who is responsible for notifying the administrator? A. Only the IAR. B. Only the IA firm. C. Both the IAR and the IA firm. D. The administrator is notified automatically by FINRA. Answer: C. Both the IAR and the IA firm. When an investment advisor representative, IAR, terminates employment with an investment advisor, IA, firm, both the IAR and the IA firm have a responsibility to notify the state administrator. This dual notification ensures that the regulatory authorities are promptly informed of the change in employment status, allowing them to update registration records accurately. For example, If an IAR leaves one firm to join another, both the old firm and the IAR must inform the administrator of the departure. Always remember that both parties share the burden of informing the administrator of an IAR's employment status change. Question 5. Under the Investment Advisors Act of 1940, which of the following would be excluded from the definition of an investment advisor? A. A financial planner who charges a flat fee for developing comprehensive financial plans. B. A person who offers advice on cryptocurrency investments for a commission. C. An attorney providing incidental investment advice solely in connection with their legal practice. D. A pension consultant who advises employee benefit plans on investment strategies. Answer: C. An attorney providing incidental investment advice solely in connection with their legal practice. The Investment Advisors Act of 1940 includes specific exclusions from the definition of an investment advisor, one of which is for professionals like attorneys, accountants, teachers, or engineers whose investment advice is solely incidental to the practice of their profession. This means their primary business is not investment advice, and any advice given is merely a byproduct of their main professional service. For example, if a lawyer, while drafting a will, suggests a general asset allocation strategy without charging a separate fee for that advice, they are not considered an investment advisor. Remember that these professionals are excluded from IA definition if their advice is purely incidental to their primary profession. Question 6. What is the primary purpose of a soft dollar arrangement? A. To allow investment advisors to pay for client commissions with non-cash benefits. B. To permit broker-dealers to offer discounts on trading commissions to large institutional clients. C. To enable investment advisors to receive research and brokerage services from a broker-dealer in exchange for client commissions. D. To provide a mechanism for broker-dealers to compensate investment advisors for client referrals. Answer: C. To enable investment advisors to receive research and brokerage services from a broker-dealer in exchange for client commissions. Soft dollar arrangements involve an investment advisor directing client brokerage transactions to a broker-dealer in exchange for research or other brokerage services, rather than direct cash payments for those services. The key concept is that the advisor is using the client's commission dollars to pay for services that benefit the advisor's clients, even if indirectly. For example, an advisor might route trades through a broker-dealer that provides valuable economic analysis or proprietary software tools. The arrangement must be disclosed to clients, and the services received must directly benefit the clients. Question 7. An investment advisor representative, IAR, is advising a client on asset allocation. The client is 60 years old, plans to retire in 5 years, and states that capital preservation is their primary objective, with a secondary goal of generating modest income. Which of the following asset allocations would be most suitable? A. 80% equities, 20% fixed income. B. 50% equities, 50% fixed income. C. 20% equities, 80% fixed income. D. 100% growth equities. Answer: C. 20% equities, 80% fixed income. Given the client's age, imminent retirement, primary objective of capital preservation, and secondary goal of modest income, a portfolio heavily weighted towards fixed income is most suitable. Fixed income investments, such as bonds, generally offer lower volatility and a more predictable income stream compared to equities, aligning with a conservative investment approach. For example, a portfolio with 80% bonds and 20% equities would prioritize protecting the existing principal while still allowing for some growth potential and income generation. Always match the asset allocation to the client's stated objectives, risk tolerance, and time horizon. Question 8. A client has opened a trust account. When determining the suitability of investments for this account, the investment advisor representative, IAR, must primarily consider the objectives and risk tolerance of which party? A. The trustee. B. The grantor. C. The beneficiaries. D. The custodian. Answer: C. The beneficiaries. When advising on a trust account, the primary consideration for suitability must be the objectives and risk tolerance of the beneficiaries, as they are the ultimate recipients of the trust's assets. While the trustee manages the assets according to the trust's terms, their duty is to act in the best interest of the beneficiaries. For example, if a trust is established for a minor beneficiary with a long time horizon, the investment strategy can be more growth-oriented, even if the trustee themselves is risk-averse. Always remember that the fiduciary duty in a trust account is owed to those who will ultimately benefit from the trust. Question 9. An investment advisor representative, IAR, receives a letter from the state administrator requesting certain records. Under the Uniform Securities Act, how quickly must the IAR generally comply with this request? A. Within 24 hours. B. Within 3 business days. C. Promptly. D. Within a reasonable time frame. Answer: C. Promptly. Under the Uniform Securities Act, when the administrator requests books and records, the general requirement is to comply promptly. This implies without undue delay and as quickly as possible under the circumstances, though it doesn't specify a fixed number of days. For instance, if an administrator is investigating a complaint, they would expect records to be produced immediately or within a very short time frame. Always remember that promptly means acting quickly and without procrastination when dealing with regulatory requests. Question 10. Which of the following investment vehicles is generally considered to have the lowest liquidity risk? A. Raw land. B. Limited partnership interests. C. Publicly traded common stock. D. Private equity investments. Answer: C. Publicly traded common stock. Liquidity risk refers to the risk that an investment cannot be quickly converted into cash without a significant loss in value. Publicly traded common stock, especially shares of large, well-known companies, are highly liquid because they are traded frequently on major exchanges, allowing investors to buy or sell them quickly at prevailing market prices. For example, if you own shares of Apple, you can typically sell them instantly during market hours. In contrast, illiquid assets like raw land or private equity can take significant time and effort to sell. Question 11. An individual wants to become an investment advisor representative, IAR, in a state where their firm is registered. Which of the following is required for their registration to become effective? A. Passing the SIE and Series 7 exams. B. Passing the Series 65 exam or the Series 66 exam, with SIE and Series 7. C. Being employed by a federal covered investment advisor. D. Having at least 5 years of experience in the financial services industry. Answer: B. Passing the Series 65 exam or the Series 66 exam, with SIE and Series 7. To register as an investment advisor representative, IAR, in a state, an individual generally must pass either the Series 65 exam, Uniform Investment Advisor Law Examination, or a combination of the SIE, Securities Industry Essentials, and Series 7, General Securities Representative, exams along with the Series 66, Uniform Combined State Law, exam. The Series 66 specifically covers state securities laws and investment advisory regulations, building on the knowledge from SIE and Series 7. For example, if you pass the SIE and Series 7, the Series 66 is your final step to qualify as an IAR. This tiered approach ensures comprehensive knowledge of both federal and state regulations. Question 12. A client contributes $6,000 annually to a traditional IRA. They are covered by a qualified retirement plan at work and have a modified adjusted gross income, MAGI, above the IRS phase-out limits. What is the tax deductibility of their IRA contribution? A. Fully deductible. B. Partially deductible. C. Not deductible. D. Deductibility depends on their total taxable income, not MAGI. Answer: C. Not deductible. For individuals covered by a qualified retirement plan at work, contributions to a traditional IRA become non-deductible once their modified adjusted gross income, MAGI, exceeds specific IRS phase-out limits. If the client's MAGI is above these limits, their contribution, although permitted, will not reduce their taxable income in the current year. For example, a high-income earner contributing to a traditional IRA while also participating in a 401k at work will find their IRA contributions are made with after-tax dollars. This rule aims to limit the tax benefits of traditional IRAs for higher earners who already have access to employer-sponsored retirement plans. Question 13. Under the Uniform Securities Act, which of the following is considered a security? A. An insurance policy with a fixed death benefit. B. A condominium purchased for personal residence. C. An investment contract. D. A futures contract on a commodity. Answer: C. An investment contract. The Uniform Securities Act broadly defines security to include various instruments, and a key component is the investment contract. The Howey test, a U.S. Supreme Court standard, defines an investment contract as an investment of money in a common enterprise with the expectation of profits to be derived solely from the efforts of others. This broad definition captures many novel investment schemes not explicitly listed elsewhere. For example, purchasing shares in a cattle breeding program where the profits depend on the efforts of the farm managers could be an investment contract. Keep in mind that a security is essentially any instrument where an investor puts money at risk expecting profits from someone else's work. Question 14. An investment advisor is compensated based on a percentage of the assets under management, AUM. This fee structure is generally considered permissible under the Investment Advisors Act of 1940 because it A. Is always performance-based. B. Does not fluctuate with market value. C. Aligns the advisor's interests with the client's long-term growth. D. Encourages frequent trading to generate higher fees. Answer: C. Aligns the advisor's interests with the client's long-term growth. Charging a fee based on a percentage of assets under management, AUM, is a common and generally permissible fee structure for investment advisors because it aligns the advisor's financial interests with the client's long-term success. As the client's portfolio grows in value, the advisor's fee increases, motivating the advisor to help the client's investments perform well. For instance, if an advisor charges 1% of AUM, they benefit directly when the client's $1 million portfolio grows to $1.1 million. This contrasts with commission-based fees, which can incentivize excessive trading. Question 15. A client's primary objective is to generate tax-free income. Which of the following investments would be most suitable? A. Corporate bonds. B. Treasury bonds. C. Municipal bonds. D. Preferred stock. Answer: C. Municipal bonds. For a client whose primary objective is to generate tax-free income, municipal bonds are the most suitable investment. The interest earned on municipal bonds is generally exempt from federal income tax and, often, state and local income taxes if the bond is issued in the investor's state of residence. For example, a New York resident investing in a New York City municipal bond would typically receive interest payments completely free of federal, state, and local taxes. This tax advantage makes municipal bonds particularly attractive to investors in higher tax brackets seeking to maximize their after-tax income. Question 16. What is the primary difference between a federal covered advisor and a state-registered advisor under the Investment Advisors Act of 1940 and the Uniform Securities Act? A. Federal covered advisors only advise institutional clients, while state-registered advisors advise retail clients. B. Federal covered advisors are regulated by the SEC, while state-registered advisors are regulated by state administrators. C. Federal covered advisors have less stringent registration requirements than state-registered advisors. D. Federal covered advisors must always have $100 million or more in assets under management, AUM. Answer: B. Federal covered advisors are regulated by the SEC, while state-registered advisors are regulated by state administrators. The primary distinction between a federal covered advisor and a state-registered advisor lies in their regulatory authority. Federal covered advisors, generally those with $110 million or more in assets under management, AUM, are regulated by the Securities and Exchange Commission, SEC. State-registered advisors, typically those below the $100 million AUM threshold, are regulated by the securities administrators in the states where they conduct business. For instance, a small local advisory firm might only need to register in its home state, while a large national firm must register with the SEC. Remember that the covered status dictates whether the SEC or state authorities have primary regulatory jurisdiction. Question 17. An investment advisor representative, IAR, is evaluating a company's financial health by examining its balance sheet. Which of the following would be found on a company's balance sheet? A. Revenue and expenses. B. Assets, liabilities, and owner's equity. C. Cash flow from operations. D. Net income and earnings per share. Answer: B. Assets, liabilities, and owner's equity. A company's balance sheet is a snapshot of its financial position at a specific point in time, always adhering to the fundamental accounting equation: assets equals liabilities plus owner's equity. Assets represent what the company owns, liabilities are what it owes, and owner's equity is the residual value belonging to the owners. For example, a balance sheet would list cash, accounts receivable, and equipment as assets, while accounts payable and long-term debt would be liabilities. Remember that the balance sheet provides a comprehensive view of a company's financial structure, showing its resources and obligations. Question 18. Which of the following would be a primary concern for an investment advisor representative, IAR, when recommending a deferred variable annuity to a 75-year-old client? A. The potential for high returns with low risk. B. The long surrender period and limited liquidity. C. The fixed income payments guaranteed by the insurer. D. The immediate tax deductibility of contributions. Answer: B. The long surrender period and limited liquidity. A primary concern when recommending a deferred variable annuity to a 75-year-old client is the typically long surrender period and the limited liquidity associated with these products. Deferred annuities are designed for long-term growth and typically impose substantial surrender charges if funds are withdrawn early, which can span 7 to 10 years or more. For an elderly client, tying up funds for such an extended period could be problematic, especially given their potentially shorter investment horizon or need for access to funds. For example, if a client needs to access their money for an unexpected medical expense within the surrender period, they could incur significant penalties. Always prioritize suitability and liquidity when considering long-term products for older clients. Question 19. Under the Uniform Securities Act, an administrator has the power to do all of the following except: A. Conduct investigations and issue subpoenas. B. Issue cease and desist orders. C. Suspend or revoke registrations. D. Modify federal securities laws. Answer: D. Modify federal securities laws. A state administrator's power under the Uniform Securities Act is broad and primarily pertains to enforcing state securities laws within their jurisdiction. They can investigate violations, issue orders, and sanction registrants. However, a state administrator does not have the authority to modify or change federal securities laws, as those fall under the purview of federal legislative bodies and the SEC. For example, an administrator can't change the rules for federal covered advisors, only regulate state-registered entities. Their authority is limited to state law, not federal law. Question 20. Which of the following actions by an investment advisor would be considered a prohibited practice under the Uniform Securities Act? A. Disclosing potential conflicts of interest to clients. B. Charging a reasonable flat fee for a financial plan. C. Exercising discretion in a client's account without written authorization. D. providing general market commentary to all clients. Answer: C. Exercising discretion in a client's account without written authorization. Exercising discretion in a client's account without first obtaining written authorization is a prohibited and unethical business practice under both federal and state securities laws, including the Uniform Securities Act. Discretionary authority means the advisor can make investment decisions, regarding asset, amount, or action, without prior client consent for each trade. For example, if an advisor buys 100 shares of XYZ stock for a client without their explicit permission for that specific trade, it is a violation unless the advisor has proper written discretionary authority. Always ensure you have written approval before exercising discretion in a client's account. Question 21. A diversified portfolio often includes both equity and fixed income securities. Which of the following statements accurately describes the general relationship between bond prices and interest rates? A. They move in the same direction. B. They move in opposite directions. C. They are unrelated. D. Bond prices only react to short-term interest rates. Answer: B. They move in opposite directions. Bond prices and interest rates generally have an inverse relationship, meaning they move in opposite directions. When interest rates rise, the value of existing bonds with lower fixed interest payments decreases because newly issued bonds offer higher yields, making older bonds less attractive. Conversely, when interest rates fall, existing bonds with higher fixed interest payments become more valuable. For example, if you hold a bond paying 3% and new bonds are issued paying 5%, your 3% bond is less desirable and its market price will fall. This inverse relationship is a fundamental concept in understanding bond market dynamics. Question 22. An investment advisor representative, IAR, is discussing risk tolerance with a client. Which of the following would be the most important factor to consider when assessing a client's risk tolerance? A. The client's current income level. B. The client's age and years until retirement. C. The client's psychological willingness to take on risk. D. The client's total net worth. Answer: C. The client's psychological willingness to take on risk. While factors like age, income, and net worth help determine a client's ability to take risk, the most important factor in assessing risk tolerance is the client's psychological willingness or comfort level with experiencing potential investment losses. A client might have the financial capacity to take on significant risk but may be too emotionally conservative to withstand market fluctuations. For instance, even a high net worth individual who panics and sells during a market downturn is not truly risk tolerant. Understanding this psychological aspect is crucial for recommending suitable investments that the client can stick with through various market conditions. Question 23. An investment advisor, IA, is subject to brochure rule requirements under the Investment Advisors Act of 1940. What is the primary purpose of Form ADV Part 2A, the brochure? A. To register the investment advisor with the SEC. B. To provide clients with detailed information about the IA's business practices, fees, and conflicts of interest. C. To report the IA's financial performance to shareholders. D. To disclose the disciplinary history of all investment advisor representatives, IARs. Answer: B. To provide clients with detailed information about the IA's business practices, fees, and conflicts of interest. Form ADV Part 2A, often referred to as the brochure, serves as a plain English disclosure document that investment advisors must provide to their clients. Its primary purpose is to offer transparency by detailing the advisor's services, fees, types of clients, methods of analysis, investment strategies, disciplinary information, and potential conflicts of interest. For example, it would clearly state how the advisor is compensated and whether they receive soft dollars. This ensures prospective and existing clients have sufficient information to make informed decisions about engaging the advisor's services. Question 24. What type of retirement plan allows for tax-deductible contributions and tax-deferred growth, with all withdrawals taxable at retirement? A. Roth IRA. B. 401k. C. Coverdell Education Savings Account, ESA. D. 529 plan. Answer: B. 401k. A 401k plan is a common employer-sponsored retirement plan that allows employees to make pre-tax, tax-deductible, contributions directly from their paychecks. These contributions and any earnings grow tax-deferred until retirement, at which point all withdrawals are taxed as ordinary income. For example, if you contribute $10,000 to your 401k this year, that $10,000 reduces your taxable income for the current year, and you won't pay taxes on it or its growth until you withdraw the funds in retirement. This tax now, tax later structure is a key feature of traditional retirement plans. Question 25. An investment advisor representative, IAR, is preparing to open a new client account. Under NASAA's model rules, which of the following is not required to be obtained from the client to determine suitability? A. Financial situation and needs. B. Investment objectives. C. Risk tolerance. D. Detailed employment history of all family members. Answer: D. Detailed employment history of all family members. While an IAR must gather extensive information from a client to determine suitability, including their financial situation, investment objectives, and risk tolerance, obtaining a detailed employment history of all family members is generally not a standard requirement for this purpose. The focus is on the client's direct financial and personal circumstances. For example, knowing the client's current job, income, and family obligations, like dependents, is important, but requiring specific employment details for every family member goes beyond what is typically necessary or relevant for suitability assessments. Stick to information directly relevant to the client's investment profile.